Welcome back to the Deep Dive. It is great to have you with us.
Good to be here.
Today, we're opening up a file that it sits right in the middle of the stack. It's something that feels incredibly mundane on the surface, but is actually doing a lot of heavy lifting for civilization.
It's one of those topics, isn't it? It's part of the plumbing.
Yeah,
You don't think about the plumbing until it leaks or, until you're buying a house and someone hands you a massive bill for it.
exactly. We are talking about the invisible safety net of the modern world. It's a word most people associate with, like high stress, confusing bank statements, and just stacks and stacks of legal paper.
Mm-hmm.
We are talking about escrow.
There it is.
And before you reach for the skip button thinking this is going to be dry financial advice, I want to promise you something.
Okay.
By the end of this hour, you are going to look at a vending machine completely differently.
That is a bold promise. I like it. But the research definitely backs it up.
Because it turns out this concept, escrow, is the glue holding together everything from billion-dollar corporate mergers to, well, buying a bag of chips.
It really is. It is the solution to a fundamental human problem.
The problem of trust.
The trust problem.
Right. So let's start there. The mission of this deep dive today is to decode the different flavors of escrow and figure out why the system even exists in the first place. But to do that, we have to go back to the basics of human interaction.
Yeah, let's strip away the modern economy for just a second.
Okay.
Imagine two strangers. They have absolutely no relationship, no reason at all to trust one another.
Right.
One has a high-value item, let's say a deed to a castle. The other has a chest full of gold.
The classic standoff, the old medieval standoff.
It is a standoff, a huge one.
Yeah.
If I hand you the deed first, how do I know you won't just jump on your horse and ride off with the deed and the gold?
And from my side, if I give you the gold first, I'm terrified you'll just lock the castle gates and leave me standing out there in the mud.
This friction, historically, was a massive barrier to trade. I mean, it's why things so often ended in violence, or you just ended up only trading with your cousins.
Right. You needed some pre-existing trust.
You did. Civilization needed a patch for this bug in human nature. We needed a neutral zone, a demilitarized zone for assets, if you will.
And that is the definition of escrow. That's what it is.
Correct. Based on the sources we have today, the strict definition is a contractual arrangement where a third party, known as the stakeholder or the escrow agent, receives and disperses money or property for the primary transacting parties.
The third wheel.
The most important third wheel in history, maybe.
So they hold the goods.
They hold the goods until everyone agrees the conditions have been met. But, and I know this was your favorite part of the research packet,
Oh, absolutely.
the word itself tells the story better than any legal dictionary ever could.
This was my big aha moment right out of the gate. I think most of us assume escrow is some Latin banking term.
Something very serious.
Yeah, like fiduciary or something that sounds very serious and expensive.
But it's not.
No. It comes from the old French word escrow. And do you know what that translates to?
A scrap of paper.
A scrap of paper, or more specifically, a scroll of parchment.
Which just paints such a vivid picture, doesn't it? In that medieval context, the escrow wasn't the money.
No.
It was the deed itself. It was the scroll, the physical thing.
So the escrow agent was literally the guy holding the scroll.
Exactly. The instruction was, I am going to hold this scroll, this escrow in my hand. I will not hand it to the buyer until I see the coins on the table.
Okay.
And I will not give the scroll back to the seller unless the buyer fails to pay.
It's the physical manifestation of the deal, just hanging in a suspended state.
That's the key phrase. A suspended state, it's a limbo. And that brings us directly to your promise about the vending machine.
Yes, let's do it. Section 1 of our outline, the everyday escrow. Because we tend to think of escrow as this thing you only do when you buy a house or maybe a business.
Some huge life-altering event.
But the research points out that we are engaging in a form of mechanical escrow all the time.
It's fascinating engineering when you break it down. Think about the user interface of a standard vending machine.
Okay, I'm picturing it.
You want a soda. It costs $1. You put a quarter in.
I hear the clunk.
You hear the clunk. But where is that quarter physically?
Well, I assume it's in the bank of the machine, right? It's in the pile with all the other quarters that people have put in.
See, that's where you'd be wrong. And that's the magic. If it went directly into the vault or the profit bin, the machine would have already accepted the transaction as revenue.
But I haven't bought anything yet.
You haven't bought anything. You've just proven you have money.
So the coin is sitting in a waiting room.
It is sitting in a physical escrow area inside the coin mechanism. It is mechanically separated from the rest of the money, It is being held in trust by the machine.
It's waiting for a condition to be met.
Exactly. The condition is user presses button B4.
So the machine is the neutral third party. The machine is the agent.
The machine is the agent. Now look at the decision tree. If you press B4 and the machine verifies it has the chips, the little coil turns, the chips fall.
Success?
That is the closing of the deal.
Yeah.
At that exact moment, a little lever or a gate opens in the escrow area, and your quarters finally drop into the secure coin vault. Revenue recognized.
But the real magic of escrow and the reason it exists is what happens if the deal fails.
Right. Let's say you stare at the machine and you realize you don't want chips, you want your money back.
So I press the coin return button.
You press the coin return,
Mm-hmm.
and it gives you your money back.
Yeah.
But notice how it gives it back. It doesn't dispense change from a tube of random quarters. It usually drops your specific coins back to you, the ones you just put in.
Because they were sitting in the escrow bucket?
They were in limbo. The machine releases the escrow back to the depositor because the transaction was canceled.
It's just returning my property.
It's a perfect physical analogy for what happens with millions of dollars in a corporate merger, just happening with 25 cents.
It prevents the machine from having to refund you, which is an accounting headache.
Precisely. And ATMs do this too, which is another great example from the source material we looked at.
Oh, right. When you deposit a stack of cash.
Yeah, if you've ever fed a stack of bills into a modern ATM, you know it takes a minute. It whirs, it clicks, it counts everything up.
Right, it's thinking.
And then a screen pops up that says, you inserted $200. Is this correct?
It's the verification stage.
And while that screen is up, your cash is in escrow inside the machine. It hasn't been mixed with the other deposits yet. It's sitting in a temporary cassette.
Ah.
So if you click No, Cancel, the machine can spit those exact bills back out at you.
Because once they are mixed, once they are commingled, you can't prove whose bill is whose.
And that is the cardinal sin of escrow, which we will definitely get to later. Commingling funds.
You have to keep the assets separate.
Always.
Yeah.
Until the deal is done.
It's amazing how much trust engineering goes into just giving a machine $20. But okay, let's graduate from the snack bar to the biggest purchase of most people's lives.
The big one.
We have to talk about real estate.
Of course.
This is where the term escrow usually enters a person's vocabulary, and usually it enters it alongside a lot of anxiety and confusion.
It's high stakes.
Mm-hmm.
In the U.S. specifically, the entire residential real estate market relies completely on this system. But, and this is a crucial distinction that the outline makes, there are actually two completely different types of escrow happening when you buy a house.
And they get confused all the time.
Constantly. You have the closing escrow, which is short-term, and then you have the mortgage escrow, which is very, very long-term.
Okay, let's break down type A, the closing escrow. This is the standoff solution we were talking about at the start.
Yes, this is the modern version of holding the scroll.
Yeah.
So you find a house, you love it, you sign a purchase contract with the seller.
Yep.
The contract says you will pay, say, $500,000. And you write a check for earnest money, let's call it $10,000, to prove you aren't just wasting their time.
But I don't give that check to the seller.
Never. Absolutely not.
Why not?
Because what if the house fails inspection? What if you find out the foundation is cracked and you want to walk away from the deal?
Right.
If the seller already cashed your check and spent it, good luck getting it back. You'd have to sue them, and that's a nightmare.
And conversely, the seller isn't going to sign the deed over to me until they know for sure that I have the other $490,000.
Of course not. So enter the escrow company, or a title company, or a real estate lawyer, depending on the state. They open a file. They are the neutral zone.
So I send my deposit to them.
You send your deposit to them. The bank sends the mortgage money to them. The seller sends the signed deed to them.
They're holding all the puzzle pieces.
They are the gatekeepers. Their entire job is to look at the contract and just check off the boxes. Is the title clear of any leads? Check. Did the inspection contingency get resolved?
Yeah.
Check. Is the fire insurance policy active and paid for? Check.
And only when every single one of those boxes is checked.
They close the escrow. In one single synchronized moment, they wire the money to the seller's bank account, they send the deed to the county recorder to officially put the house in your name, and they pay themselves their fee out of the funds.
And that's it. That particular escrow is closed. The scroll has been handed over.
The transaction is complete. But for most Americans with a mortgage, that is just the beginning of their relationship with the word escrow.
Right.
Because now we enter type B, the mortgage escrow.
This is the one that confuses people on a monthly basis. This is the impound account.
Right. And to understand this, we have to understand the acronym PITI. PITI.
Principal, interest, taxes, and insurance.
Principal and interest,
Yeah.
that's your loan. That's the part that goes to the bank to pay off what you borrowed. That's straightforward.
Sure.
But the taxes and insurance, the T and the I, that's where the escrow account comes in.
The question I always had, and I think a lot of people have, is why does the bank even care? I mean, I owe the bank money for the loan, sure. Why do they want to be involved in paying my property taxes to the county?
Mm-hmm.
Why not just let me write a check to the county myself? Seems like extra work for them.
It's a great question, and the answer is brutal but simple. They don't trust you to protect their investment.
It always comes back to trust. Or lack of it.
Always. Think about it. If you start paying your credit card bill, what happens? You get a bad credit score, maybe a collection agency calls you. Annoying, but that's about it.
Right?
But if you stop paying your property taxes, what happens?
The government gets angry. Very angry.
The government places a tax lien on your home. And in most jurisdictions, a government tax lien has super priority.
Super priority. What's that?
It means it cuts in line. It jumps to the very front of the line of everyone you owe money to, right in front of the mortgage.
Wait, so the government gets paid before the bank?
Yeah.
Even though the bank gave me the money for the house?
Yes. If the government forecloses on your house for unpaid taxes, they get their money first. The bank gets whatever scraps are left over. The bank could lose their entire collateral.
So they are terrified of this.
They are terrified of tax mills.
Right.
So the bank says, we are going to give you the option to forget to pay.
They take away the choice.
Exactly. They say, we are going to estimate your annual tax bill.
Yeah.
We're going to divide it by 12, and we are going to force you to pay that portion to us every single month.
And they put it in a bucket.
They put that money into an escrow bucket, a separate savings account that's attached to your loan. And when the tax bill arrives from the county, they pay it for you from your money.
They protecting their position in the line.
And it's the same exact thing with hazard insurance.
Mm.
If the house burns down and you forgot to pay the insurance premium,
The asset is gone.
the asset is gone.
Yeah.
The bank is left holding a loan for a pile of ash. So they escrow the insurance payments too.
Okay, now this leads directly to the phenomenon that drives homeowners crazy, the escrow analysis.
The annual letter of doom. I've gotten a few of those.
You get a fixed rate mortgage, you sign the papers, you think, okay, great, my payment is $2,000 a month for 30 years, predictable.
Right.
And then 2 years later, the bank sends a letter saying, just kidding, it's now $2,150 a month.
And people feel like they've been lied to. They feel like the bank just changed the rules.
But the loan is fixed, the P&I part, the principal and interest, that didn't change.
The T&I changed. The taxes and insurance changed.
Because taxes and insurance, they never ever seem to go down.
Well, there's inflation. Property values go up, which means taxes go up. These costs are variable. And the source material gives a really clear example of how this math works. And it explains why the payment increase always feels bigger than it should be.
Okay, yeah, let's walk through the shortage concept. This is important.
Okay, let's say your homeowner's insurance premium goes up by $120 for the year.
All right, so that's $10 a month.
$10 a month. Logic would say your total monthly payment should just go up by $10.
Sure, seems simple enough.
But here's what actually happens. The bank usually has to pay that annual insurance bill before they get around to adjusting your monthly payment.
Ah,
So they pay the insurance company the new, higher rate in, say, January. But you've been paying the old, lower rate into the escrow bucket all of last year.
so the bucket doesn't have enough money in it?
The bucket is worse than empty. It's overdrawn from the bank's perspective, or at least it's below the minimum balance they're required to keep. There's a shortage.
Okay.
So now the bank's analysis says, okay, for the next year, we need to raise your payment by $10 a month to cover the new higher price going forward. But we also need you to pay us back for the $120 shortage we had to cover for you this year.
So they spread that shortage out over the next year, too.
They'll add another $10 a month just to pay back the shortage. So now your payment is up by $20, not $10.
So they double dip, in a way.
And on top of that, federal regulations, RESPA, the Real Estate Settlement Procedures Act, allow them to keep a cushion in the account, usually equal to about 2 months of escrow payments.
A buffer.
A buffer. And if the payments go up, the required cushion has to get bigger too. So they might add even more to your payment to build that cushion back up.
So a simple $10 a month increase in your actual costs can easily turn into a $25 or $30 increase in your monthly payment for a year.
Exactly. Until the shortage is paid back and the cushion is full again. It's an automated reality check. It's the adulting tax applied automatically by a bank's algorithm.
And for certain types of loans, like FHA loans, you have no choice in this matter.
That's
Yeah.
correct. The source notes that Federal Housing Administration loans require this escrow account for the entire life of the loan, no exceptions.
Yeah, with a conventional loan.
With a conventional loan, if you have enough equity, usually 20% or more, you can sometimes petition the bank to cancel the escrow account and let you pay your own taxes and insurance.
But then you have to be disciplined enough to save up that huge chunk of money yourself for when those big bills come due.
Which brings us right back to why the system exists in the first place.
It mitigates risk.
For the lender.
Okay, that's a very deep dive into the U.S. model, but our mission is global. So let's look at Section 3, global perspectives. How does this work in, say, the U.K.?
It's interesting. In the U.S., escrow is an industry. You have escrow officers and title companies that specialize in this.
Right.
In the UK, you don't really have that distinct industry. The function absolutely exists, but it's handled by the lawyers involved in the transaction.
Just solicitors.
Solicitors, or a professional called a licensed conveyancer.
I love that term, conveyancer. It sounds like someone who moves luggage at a fancy hotel.
It's the person who conveys the title of the property from one person to another. But effectively, they do the same thing. They hold the buyer's deposit in a special client account until the deal is done.
So it's integrated into the legal process.
Exactly. But the source material highlights some other uses in the UK that I think are really clever and are becoming more common elsewhere, specifically for things like secondhand cars.
This stood out to me. Buying a used car is the Wild West. You meet a stranger in a parking lot, you kick the tires, you hand over an envelope of cash. It feels incredibly dangerous.
It is dangerous. It's a classic lemon market, as the economists call it. You don't know if you're getting a good car or a lemon. But in the UK, and increasingly elsewhere, they're using escrow services for this.
How does that work for a car?
It's the same principle. The buyer deposits the money into a secure online account held by a third party.
Okay.
The seller gets a notification that the money is there. It's verified. So the seller delivers the car.
And then what?
The buyer gets an inspection period, a day, 2 days. They can take it to their mechanic. Does it start? Is the engine block cracked? If it's good, they go online and click a button to release the funds.
And if it's a piece of junk?
They reject the transaction, and the money stays locked until they've returned the car. It eliminates the scam where the seller just takes the cash and runs.
That seems like it would solve so many problems on places like Craigslist or Facebook Marketplace.
It creates a trust bridge. And they use it for construction, too. This is a big one.
Oh, home renovation horror stories. I paid the contractor $5,000 for materials and he just never came back.
We've all heard that story. It's a classic. In the UK, it's becoming common to put that money in escrow. The builder knows the money is there, so they aren't worried you're going to stiff them at the end.
Okay, so it protects them.
But they can't touch it until the work meets a pre-agreed defined standard.
Like, phase 1 is complete when the foundation is poured and inspected.
Exactly. It aligns the incentives perfectly. It forces honest behavior because the money is trapped in that neutral zone until the promise is kept.
Speaking of scams and the Wild West,
Mm.
we have to talk about the internet. Section 4, the digital frontier.
This is where escrow went from being a kind of boring legal term to a critical piece of tech infrastructure for the entire global economy.
Think back to the early days of eBay. We're talking late 90s.
The Beanie Baby era.
The Beanie Baby era. You are buying a rare collectible from user 123 in Nebraska. You're in New York. You have to send them a money order.
A physical piece of paper representing cash. You had to go to the post office.
Yeah, you put it in the mail,
Yeah.
and then you wait. And you just pray that user 123 is a decent human being and will actually ship you the thing you paid for.
That friction, that terror of being ripped off, was a massive limit on the growth of e-commerce. You couldn't build a real marketplace on blind faith.
You might buy a $10 book, but you're not going to buy a $2,000 vintage guitar that way.
No chance.
Yeah.
So Internet Escrow was born to solve this exact problem.
Right. Companies like Escrow.com, which the source says was founded by Fidelity National Financial way back in 1999, they basically digitized the scroll.
It did.
Walk us through the mechanics of a typical online escrow deal. Because it has that specific feature, the inspection period, that I think is the crucial innovation.
Right. So step 1, the buyer and seller agree on the price online.
Okay.
Step 2, the buyer pays the escrow service. Very important. You do not pay the seller.
And the service verifies the funds.
They verify the funds are good. It's not a bounced check. It's not a stolen credit card. Then they notify the seller. We have the cash. It is safe. You are cleared to ship the item.
So the seller's protected. They know they aren't shipping their valuable goods to a deadbeat.
Exactly. So the seller ships the guitar. The buyer receives it. Now the clock starts on the inspection period.
You agree to that ahead of time?
Yes. Usually it's set to a specific number of days, let's say 48 hours.
So I have 2 days to open the box, play the guitar, make sure it's the real deal and not a counterfeit.
And if you do nothing, or if you log in and click accept, the money is automatically released to the seller. The deal is done.
And if I open the box and it's just a brick with strings drawn on it.
You log in and click reject, the money remains frozen in escrow. The process then guides you to ship the brick back to the seller.
And once the seller gets it back,
Once tracking shows it's been returned, the money is refunded to you.
it neutralizes the risk for both sides.
It effectively removes the risk of the classic take the money and run scam. But, and this is a huge but, the scammers are smart. They adapted.
This is the bogus escrow section of the outline. This is truly insidious stuff.
It is. Scammers realized that people were learning to trust the word escrow. So they thought, well, let's just create our own.
They started setting up fake escrow websites. How do you even spot a fake?
It's incredibly hard. They copy the logos and the design of legitimate companies. They use all the right words. Bonded, insured, secure. They create a beautiful, professional-looking website.
So the scenario is, I'm trying to buy a car on Craigslist. The seller says, hey, I'm in the military and I'm stationed out of the country, but let's use this great escrow service to make sure we're both safe. Here is the link.
And that is the #1 red flag. Here is the link.
Oh.
If you click the link provided by the seller, you go to the fake site they control.
And it looks real.
It looks perfect. You register, you see instructions to wire money to their secure account. You wire the money.
But you aren't wiring it to a neutral third party.
You are wiring it directly to the scammer's bank account in another country. And once that wire transfer clears, the money is gone forever. The website disappears. The seller disappears.
That is terrifying. So the advice from the source is
To verify, always, never, ever trust the link provided by the other party in the transaction.
do your own homework.
Do your own homework. If they say, let's use escrow.com, don't click their link. Open a new browser window, go to Google, search for the official site yourself.
And check the government registry.
That's the most important step. These companies have to be licensed. In the U.S., it's a state-by-state thing. California, Arizona, Idaho, they have specific licenses for internet escrow. In California, it's the Department of Business Oversight.
You can look them up online.
You can go to the government website and search for the company by name. If they're not on that official list, do not send them a penny.
It's a regulatory patchwork in the U.S., isn't it? Very fragmented.
It really is. The federal government doesn't have a single unified license for this. It's incredibly fragmented, which can be confusing. Now compare that to Europe.
The EU seems to have streamlined this quite a bit.
They did. In 2009, the EU passed something called the Payment Services Directive. It basically harmonized the rules for these kinds of services across the entire continent.
And what was the impact of that?
It allowed for very low-cost escrow services to operate across the entire EU. The source mentions the cost difference. In the old days, for a big international transaction, you'd need a bank letter of credit.
Which is very expensive.
Thousands of euros sometimes. The directive made it possible for services to do the same thing for cents. It democratized trust. It made it possible to use escrow for smaller, everyday transactions, not just huge corporate mergers.
Which brings us to a different kind of asset. We've talked about physical things, houses, cars, guitars, but we live in an information economy. Section 5. Intellectual property and source code.
This is a huge area that most consumers never see, but it is absolutely critical for keeping the business world running.
The black box problem.
Exactly. Imagine you are a massive bank. You rely on a specific software platform to run all of your checking accounts. It's the core of your business.
Okay.
And you buy a license for that software from a small, brilliant startup in Silicon Valley.
So, software as a service. SaaS.
Right. You don't own the software. You just rent it. You get the object code, the compiled program that runs. You do not get the source code, the human-readable instructions, the secret recipe.
Because that's the startup's most valuable asset. They're never going to give that to me.
Exactly. But now, as the bank, you have a massive risk. What if that startup goes bust? What if they run out of cash and just shut down their servers next Tuesday?
My bank's checking account stopped working. My customers would panic. It would be a catastrophe.
And you can't fix it because you don't have the recipe. You are locked out of the black box.
So, source code escrow.
It's an insurance policy, a very specific one. The startup agrees, as part of their contract with the bank, to deposit a copy of their source code with a neutral third-party escrow agent.
And they keep it updated.
Every time they release a new version of the software, they have to update the deposit in the vault.
And it just sits there.
It sits there, encrypted and untouched.
Yeah.
Unless a trigger event happens.
A trigger event, what's that?
The contract defines these triggers very carefully. Things like if the startup declares Chapter 7 bankruptcy, or if the startup fails to provide technical support for more than 72 consecutive hours, or even if the key personnel, the main developers, die or leave the company.
If one of those triggers is pulled,
The escrow agent breaks the glass. They're authorized to release the source code to the bank.
so the bank can then hire its own engineers to read the code, fix bugs, and keep the system running.
It's a business continuity plan. It prevents the customer from being held hostage by the vendor's failure.
And the sources point out this applies to a lot more than just software code.
Oh yeah, it's called information escrow, more broadly.
So what else can you put in there?
Industrial designs, chemical formulas, manufacturing blueprints, lab notebooks, even creative work.
The outline mentions TV scripts and musical compositions.
Right. There's something called the International Creative Registry. Think about if you're a screenwriter. You write a brilliant script for a movie. You go pitch it to a big Hollywood studio.
And they say, no thanks, we'll pass.
They pass. 5 years later, they release a blockbuster movie that looks suspiciously like your script.
And you want to sue them, but they just say, nope, we developed this internally, we never saw your script.
It's your word against their army of lawyers. Unless you used escrow. If you deposited your script with a registry before you ever pitched it, you have third-party, timestamp proof.
Here's the script, dated and sealed by an independent agent from 5 years ago.
It's a time capsule. A notarized time capsule that establishes your rights and the date of creation.
Okay, we are moving up the food chain now to the absolute peak of high finance. Section 6, corporate mergers and acquisitions, M&A.
This is where the numbers just get silly. We're talking hundreds of millions, even billions of dollars.
When Company A buys Company B, it's not like buying a used car. The due diligence process is insane.
It takes months, sometimes years.
Yeah.
But even with all that checking, there is always a risk. The seller makes certain promises. They say, we have no lawsuits pending against us. That is called a warranty.
But promises can be broken, or people can just be wrong without knowing it.
Exactly. So the buyer asks for an indemnity, which basically means if it turns out you were wrong about that promise, you have to pay me back for any damage it causes.
But if I've already paid you $1 billion for your company, and you've distributed all that money to your shareholders, how am I possibly going to get it back from you?
You can't. It's like trying to put toothpaste back in the tube. It's gone. So big M&A deals almost always use a holdback.
A holdback.
They put a chunk of the purchase price, maybe 10 or 15%, so it could be $100 million, into an escrow account instead of paying it to the seller at closing.
For how long does it sit there?
Usually for an extended period, like 12 to 24 months after the deal closes. It just sits there. If a surprise lawsuit pops up or a tax audit from 3 years ago goes bad,
The buyer can make a claim.
the buyer can take the money to cover the damages straight from that escrow account. They don't have to chase the seller and try to sue them.
It's leverage
Yeah,
and security.
it is. But when you have $100 million just sitting in a bank account for 2 years, new problems arise.
Interest.
Oh, right. $100 million earns a decent amount of interest.
Millions of dollars in interest.
So the lawyers have to fight and negotiate over who gets the interest. Does it go to the buyer? The
Yeah.
seller? Do they split it? It's a huge point of contention.
And the credit worthiness of the bank holding the money?
That's a huge point in the research. You don't want to escrow your $100 million holdback in a bank that might collapse next year.
No.
So they fight over which financial institution gets to be the agent. They have to be rock solid.
There is one more legal use case here that I think affects a lot of normal people. Class action lawsuits.
Yes. We've all gotten those emails or postcards in the mail. If you bought this specific brand of milk in 2014, you may be entitled to a settlement of $1.50.
And usually I just ignore them, but someone has to manage that whole process.
Imagine you're the company that got sued. You agree to settle the case for, say, $50 million.
Okay.
You do not want to be in the business of mailing out 10 million checks for $1.50. You want to wash your hands of it and move on.
You want finality.
So you wire the entire $50 million to a qualified settlement fund, which is basically just a big escrow arrangement. Once that wire hits, the defendant is out. They are done. Their part is over.
And the escrow agent or the fund administrator deals with the whole headache.
They're the ones who have to find all the claimants, process the forms, deal with disputes, and cut all the checks. And often, They pay themselves their administrative fees right out of that fund.
It separates the punishment from the logistics.
Correct.
And finally, in this section, we can't talk about stakes without talking about the origin of the term stakeholder. Gambling.
The oldest form of risk, probably.
If you and I bet $50 on the Super Bowl and we don't really trust each other to pay up,
We give the money to a third guy, a neutral friend, the stakeholder. He holds the stakes.
it's the purest form of escrow there is.
It is. And it highlights the golden rule of the escrow agent, which brings us to the fine print section. The agent must be absolutely, completely neutral.
Neutrality is key.
The agent cannot care who wins the Super Bowl. They cannot care if the M&A deal goes through or falls apart. They only care about the written instructions. If Team A wins, pay Bob. That's it. They're a robot made of law.
But what if the robot messes up? Being an escrow agent sounds incredibly stressful if you lose the money or send $1 million to the wrong person.
The liability is tricky. You would think they are held to the absolute highest legal standard, like a trustee.
Yep.
But the source points out that many escrow contracts try to limit the agent's liability to just gross negligence.
So an honest mistake, a simple screw-up, might be forgiven.
It depends on the contract and the local laws, but they often include indemnity and hold harmless clauses.
What does that mean?
It basically says, if the buyer and seller get into a lawsuit with each other over this deal, leave me out of it. And if you try to drag me into it, you have to pay all my legal fees.
They protect themselves first.
They have to. But the one thing they absolutely cannot do, the thing that will send an escrow agent to jail, is commingling.
Explain that. What is commingling?
You cannot mix the client's money with your own business operating money, ever. You can't use the money in the escrow account to pay your office rent for the month, even if you fully intend to put it back next week.
The money has to remain sacred. It has to be separated.
The moment you touch that client money for your own use, you have committed theft. It has to stay in the escrow area, just like the quarters in the vending machine.
So we've gone from the medieval scroll, the escrow, all the way to the coin suspended in the soda machine, to the massive impound accounts for our property taxes, to the source code vaults of Silicon Valley.
It's quite a journey. It's a journey through the architecture of trust itself.
When you step back and you look at this whole landscape, what is the big takeaway for you? What's the core theme?
For me, it's the realization that trust in a complex, modern society isn't a feeling. It's not an emotion. It's a mechanism.
It's an engineered system.
An engineered system. We can't rely on knowing everyone personally anymore. We trade with people we will never meet who live on the other side of the planet.
So we have to outsource the trust.
We build a neutral zone. We build systems, whether it's a simple machine, a law firm, or a complex bank, that are designed to hold the pieces until the puzzle is complete. It's what allows the economy to function at scale without everyone needing to be best friends.
It's the lubricant of capitalism.
It really is.
Yeah.
Without it, the gears would grind to a halt.
I want to leave the listener with a thought today. We are moving very quickly into a world of smart contracts, of blockchain, of crypto, and we hear this word all the time. Trustless systems.
Code is law. That's the mantra.
Exactly. And in a way, a smart contract is just a fully automated escrow agent. It holds the digital assets and releases them automatically when the code says the conditions are met.
The ultimate vending machine.
The ultimate vending machine. But it raises a really profound question for me. If the code is the agent, who audits the code? Who is holding the scroll when the scroll is writing itself?
That is the billion-dollar question for the next decade, isn't it? If there's a bug in the escrow code, there was no manager to call. There's no court to appeal to.
Something to mull over the next time you put a quarter in a slot and wait for that clunk. Thanks for diving deep with us today.
My pleasure, as always.
We'll see you on the next one. Stay curious.